Spread measures are essential tools in fixed income analysis because they isolate the compensation investors receive for bearing risks beyond the time value of money. While government yield curves primarily reflect risk-free interest rates, spread measures capture additional compensation for credit risk, liquidity risk, and market uncertainty. Analysts use spreads to compare bonds, evaluate relative value, and monitor economic conditions. Common spread measures covered in the program include the swap spread, I-spread, Z-spread, TED spread, and MRROIS spread. Each measure serves a distinct purpose and provides insights into different aspects of fixed income markets, risk assessment, and bond valuation. The swap spread is the amount by which the swap rate exceeds the yield of a government bond with the same maturity. Because government securities generally have lower credit risk than banks, swap spreads are usually positive. Swap spreads provide information about banking sector credit quality and liquidity conditions. A widening swap spread may indicate increasing credit concerns or reduced liquidity in financial markets. The swap rate curve itself reflects the borrowing costs of high-quality commercial banks and is widely used as a benchmark for valuation. Therefore, swap spreads help analysts assess relative risk premiums embedded in fixed income markets and identify potential mispricing opportunities. The I-spread, or interpolated spread, measures the difference between the yield of a credit-risky bond and the corresponding swap rate of the same maturity. If an exact swap maturity is unavailable, analysts estimate the swap rate using linear interpolation along the swap curve. Unlike a bond's yield, which incorporates both time value and risk compensation, the I-spread primarily reflects compensation for credit and liquidity risks. Higher I-spreads indicate greater perceived risk associated with the issuer. Portfolio managers and credit analysts frequently use I-spreads to compare bonds issued by different companies and to evaluate changes in market sentiment toward corporate creditworthiness. The Z-spread, or zero volatility spread, is a more comprehensive measure because it considers the entire spot rate curve rather than a single benchmark rate. It represents the constant spread that must be added to every spot rate on the benchmark curve so that the present value of a bond's cash flows equals its market price. A higher Z-spread indicates higher perceived risk and greater required compensation by investors. However, the Z-spread is most appropriate for option-free bonds because it assumes zero interest rate volatility. For bonds with embedded options, the Z-spread may incorrectly include compensation for option risk in addition to credit and liquidity risk. Short-term interest rate spreads provide valuable information about economy-wide credit and liquidity conditions. The TED spread measures the difference between the market reference rate, MRR, and the yield on short-term Treasury bills of the same maturity. Because Treasury bills are considered nearly risk-free, increases in the TED spread indicate heightened concerns regarding bank creditworthiness and liquidity. Similarly, the MRROIS spread compares unsecured interbank borrowing rates with overnight indexed swap rates that contain minimal credit risk. Both measures serve as important indicators of stress in the banking system and often widen significantly during periods of financial instability. Traditional theories of the term structure explain the relationship between interest rates and maturities. The unbiased expectations theory, also known as the pure expectations theory, argues that forward rates reflect only expected future spot rates. Under this framework, investors are assumed to be risk-neutral and indifferent among investment strategies with identical expected returns. Consequently, an upward-sloping yield curve implies expectations of rising short-term interest rates, while a downward-sloping curve signals expectations of falling rates. Although this theory provides an intuitive framework for interpreting yield curves, it does not account for risk premiums demanded by investors for holding longer-term securities. The liquidity preference, segmented markets, and preferred habitat theories extend the expectations framework by incorporating investor behavior and risk considerations. Liquidity preference theory suggests that forward rates equal expected future spot rates plus a maturity-related liquidity premium, causing longer-term bonds to offer higher yields. Segmented markets theory proposes that yields at different maturities are determined independently by supply and demand within each maturity segment. Preferred habitat theory combines elements of both approaches, recognizing that investors prefer specific maturity ranges but may move outside their preferred habitats if sufficiently compensated. Together, these theories help explain the diverse shapes observed in yield curves across different economic environments. Yield curve risks arise from unexpected changes in the level, slope, or curvature of interest rates. Portfolio managers measure these risks using effective duration, key rate duration, and multi-factor yield curve models. Effective duration evaluates sensitivity to parallel shifts in rates, while key rate duration isolates exposure to changes at specific maturities. Economic factors such as inflation expectations, GDP growth, monetary policy, fiscal policy, and investor demand influence yield curve movements. The term structure of yield volatility further indicates how uncertainty varies across maturities, with short-term rates often exhibiting greater volatility than long-term rates. Understanding these relationships enables managers to position portfolios strategically and manage interest rate risk effectively.